What if I told you that the 2008 financial crisis never actually ended? What if the bailouts, the stimulus packages, the emergency measures that supposedly saved the global economy, what if they were just the opening act of something far more dangerous? Here is what they do and want you to understand. Between 2008 and 2010, the United States Federal Reserve quietly engineered the largest wealth transfer in human history. $7 trillion. Not in taxpayer bailouts alone, but in overnight lending, emergency liquidity injections, and off-balance sheet agreements that most Americans never even heard about. And here's the kicker, that $7 trillion wasn't the cure. It was the morphine drip that kept a dying patient awake long enough to get addicted. Right now, today, you're paying for it. Every time you see your grocery bill climb, every time your rent goes up, every time you wonder why a decent house costs 10 times what your parents paid, you're living inside the consequence of that decision. The dollar in your pocket? It's been silently diluted by the very institutions that promised to protect it. This isn't a conspiracy theory. This is monetary history they hope you never connect. So before we go further, drop a comment below and tell me where you're watching from. I want to know how many of you are feeling this squeeze in real time. And if you're here for the unfiltered truth, the kind of financial breakdown they don't teach in schools, hit that subscribe button right now. Because what I'm about to show you will completely change how you see the system. Let's rewind the clock and expose the machine. To understand how $7 trillion vanished into the financial system without most people noticing, you need to understand the architecture of modern banking. And to understand that, we need to go back to September 15th, 2008. The day Lehman Brothers collapsed. Lehman wasn't just another bank failure. It was the fourth largest investment bank in the United States, with over $600 billion in assets. When it went under, it triggered a cascade of panic across global markets. Credit froze. Banks stopped lending to each other. The commercial paper market, the invisible engine that funds everyday business operations, seized up completely. Within 72 hours, the entire global financial system was on the brink of total systemic failure. But here is what they do and tell you in the documentaries. Lehman didn't collapse because of bad luck or a few rogue traders. It collapsed because of a shadow banking system built on derivatives, leverage, and something called rehypothecation. Let me break that down. Imagine you own a car. You use that car as collateral to borrow money from Bank A. But here is the twist. Bank A then uses your car as collateral to borrow money from Bank B. And Bank B uses it again to borrow from Bank C. One car, 3 loans. That's rehypothecation. Now scale that up to trillions of dollars in mortgage-backed securities, corporate bonds, and treasury bills, all being reused as collateral in an endless daisy chain of debt. Sound familiar? This is exactly what's happening right now in the repo market. Every single night, major financial institutions borrow hundreds of billions of dollars using the same collateral over and over again. The Federal Reserve has become the lender of last resort. Not occasionally, but permanently. In 2023 alone, the Fed's balance sheet still carried over $7 trillion in assets. Most of it accumulated during the emergency measures of 2008 and the COVID-19 pandemic response. By 2007, Lehman Brothers was leveraged 31-to-1. That means for every dollar of actual capital they had, they borrowed $31 to make bets in the market. When those bets went bad, specifically their massive positions in subprime mortgage-backed securities, the entire house of cards collapsed. Lehman had over $900 billion in liabilities when it declared bankruptcy. $900 billion. But Lehman was just the most visible domino. Behind the scenes, American International Group, AIG, was imploding even faster. AIG had sold hundreds of billions of dollars in credit default swaps, essentially insurance policies on mortgage-backed securities. When those securities went toxic, AIG was on the hook. By September 16, 2008, just one day after Lehman collapsed, the Federal Reserve stepped in with an $85 billion emergency loan to keep AIG alive. Sound familiar? That $85 billion eventually ballooned to over $180 billion in total government support for a single company. Why? Because AIG's failure would have triggered payouts to every major bank in the world. Goldman Sachs, Societe Generale, Deutsche Bank. They were all counterparties. If AIG went down, it would take the entire derivatives market with it. And that market, in 2008, was valued at over $600 trillion in notional value. $600 trillion. That's more than 10 times global GDP. This is the hidden architecture of modern finance. A web of interlocking derivative contracts so complex that no single institution, not even the regulators, fully understands the exposure. When one node fails, the contagion spreads instantly. It's not a market anymore. It's a suicide pact with leverage. And here's where it gets even darker. The official narrative says the Fed and the Treasury Department saved the system with swift, decisive action. The Troubled Asset Relief Program, TARP, authorized $700 billion in taxpayer funds to buy up toxic assets and stabilize banks. But that's just what made the headlines. What didn't make headlines was the Federal Reserve's emergency lending programs. Between 2007 and 2010, the Fed extended over $16 trillion in ultra-low interest loans to financial institutions around the world. $16 trillion. That number was only discovered years later when the Government Accountability Office, the GAO, conducted an audit and published the findings in 2011. $16 trillion lent in secret, with almost no public oversight, to banks that had gambled themselves into oblivion. Sound familiar? Because, right now, in 2025, the Fed's reverse repo facility is quietly propping up money market funds to the tune of hundreds of billions of dollars every single night. The same emergency mechanisms that were supposed to be temporary in 2008 have become permanent features of the financial system. We're not living in a recovered economy. We're living in a permanently medicated one. Let's talk about who got that money. Citigroup received over $2.5 trillion in total Fed support. Morgan Stanley, $1.9 trillion. Merrill Lynch, which was collapsing so fast it had to be emergency sold to Bank of America, received over $2 trillion in Fed loans. Even foreign banks got in on the action. The Royal Bank of Scotland, Deutsche Bank, UBS, Barclays, all received hundreds of billions in dollar liquidity from the American Federal Reserve. Why? Because the entire global banking system runs on dollars. Every international trade, every commodities contract, every sovereign debt issuance, it's all denominated in US dollars. When the dollar credit system froze in 2008, it threatened to collapse not just American banks, but the entire architecture of global commerce. The Fed wasn't saving banks, it was saving dollar hegemony, and that system is built on one fundamental assumption: infinite liquidity. As long as the Federal Reserve can print dollars and inject them into the financial system, the game continues. But here's the cost. Every dollar created dilutes the value of every dollar already in circulation. That's not a glitch. That's inflation by design. In 2008, the Fed's balance sheet was under $900 billion. By 2015, it had ballooned to $4.5 trillion. During COVID-19, it exploded to nearly $9 trillion. As of 2025, even after so-called quantitative tightening, it's still hovering above $7 trillion. That's $7 trillion of assets, mostly treasury bonds and mortgage-backed securities, sitting on the Fed's balance sheet. $7 trillion that didn't exist before 2008. This is the bailout they're not talking about. Not the visible TARP funds, but the invisible expansion of the money supply itself. And you're paying for it every single day in the form of asset price inflation, wage stagnation, and the quiet, relentless erosion of purchasing power. But here's where the story takes a turn that even the skeptics don't see coming. The bailouts weren't a response to the crisis. They were the fulfillment of a system designed to fail upward. And the man who orchestrated the entire operation wasn't some shadowy central banker or rogue treasury secretary. He was the former CEO of Goldman Sachs. His name? Henry Paulson. In 2006, Paulson left Goldman Sachs, where he'd served as chairman and CEO, to become the United States Secretary of the Treasury under President George W. Bush. Just 2 years later, he was the man standing in front of Congress demanding $700 billion in emergency funds to save the financial system. The same system his former firm had profited from for decades. Now here is the detail that should make your blood run cold. In the months leading up to the Lehman collapse, Goldman Sachs was quietly shorting the very mortgage-backed securities it had been selling to clients. Internal emails later revealed that Goldman traders referred to some of these products as junk and crap. They knew the securities were toxic, and they bet against them. When the market collapsed, Goldman made billions while their clients lost everything. And the man who engineered the bailout that saved Goldman, the former CEO who left just 2 years earlier with a $634 million severance package. You can't make this up. But Paulson wasn't acting alone. He was joined by Ben Bernanke, the Federal Reserve Chairman, and Timothy Geithner, the President of the New York Federal Reserve, who would go on to become Treasury Secretary under Obama. Together, this trio made decisions in real time, behind closed doors, that reshaped the global financial system forever. No votes, no public debate, just emergency powers and the implicit threat that without their intervention, the entire economy would collapse. And maybe it should have, because what they actually did was enshrine a doctrine that has defined finance ever since. Moral hazard on an industrial scale. They proved that if you're big enough, reckless enough, and connected enough, you will never be allowed to fail. The risk is privatized when you win. The losses are socialized when you lose. It's not capitalism. It's a cartel with a central bank. Here's the mechanism they used. And this is critical. The Federal Reserve didn't just lend money to banks. It accepted collateral that was essentially worthless. Mortgage-backed securities that were trading at 30 cents on the dollar were accepted by the Fed at near face value. The Fed became the buyer of last resort for assets no one else would touch. In doing so, it transferred the risk from private balance sheets to the public balance sheet. Your balance sheet. This wasn't a loan. It was a gift wrapped in the language of emergency liquidity. And the receipts? They're buried in the Federal Reserve's own audit data, in footnotes of GAO reports, in the fine print of emergency lending facility disclosures. But the numbers are there, and they tell a story of systemic capture that goes beyond anything most people imagine. You won't believe the name of the single largest recipient of Fed emergency support during the crisis. It wasn't Bank of America. It wasn't Citigroup. It wasn't even AIG. The receipt is wilder than you think. And I'm going to show you exactly how deep the rabbit hole goes. Let's pull back the curtain and talk about how modern finance actually works. Because once you see it, you can't unsee it. The core of the 2008 collapse, and the $7 trillion bailout that followed, rests on a single financial innovation that most people have never heard of: the shadow banking system. This is not some fringe conspiracy. This is mainstream economic terminology. The shadow banking system refers to all the financial activity that happens outside the regulated banking sector: hedge funds, money market funds, investment banks, special purpose vehicles, securitization trusts. These entities perform bank-like functions, lending, borrowing, creating credit, but they operate without the same oversight, capital requirements, or deposit insurance. By 2007, the shadow banking system in the United States held over $20 trillion in assets. That's larger than the traditional banking system, and it was almost entirely funded by short-term borrowing in the repo market. Here's how it worked, and this is the mechanism that broke the world. A hedge fund wants to make a leveraged bet on mortgage-backed securities. It doesn't have enough cash, so it borrows money in the repo market. Repo stands for repurchase agreement. Essentially, the hedge fund sells a security to a lender, like a money market fund, with an agreement to buy it back the next day at a slightly higher price. That difference is the interest. It's a one-day loan, collateralized by the security itself. Sounds safe, right? Collateralized lending. But here's the trick. The same security gets used over and over. The money market fund that just bought the security turns around and repos it out to another institution. And that institution repos it out again. This is rehypothecation on steroids. One treasury bond might serve as collateral for 5, 10, even 20 different loans simultaneously. It's a leverage multiplier that turns $1 of real assets into $20 of perceived capital. As long as everyone believes the collateral is good, the system works. But the moment doubt enters the equation, the whole thing implodes. And in 2008, doubt became certainty. Mortgage-backed securities, the primary collateral in the repo market, started defaulting. Subprime borrowers, people who should never have been given loans in the first place, began missing payments. Foreclosures spiked. Suddenly, the securities backed by those mortgages were worth a fraction of their face value, but they were still being used as collateral for trillions of dollars in overnight lending. When Lehman Brothers declared bankruptcy on September 15, 2008, it held over $639 billion in assets. But those assets were almost entirely financed by short-term repo borrowing. When the market lost confidence in Lehman, lenders refused to roll over the repos. Lehman couldn't fund itself. In less than 48 hours, it went from a global powerhouse to insolvent. This is the true nature of a bank run in the 21st century. It's not depositors lining up outside a branch. It's institutional lenders pulling liquidity in the overnight market. Silent, invisible, and instantaneous. The Fed's response was unprecedented. It created a series of emergency lending facilities with names that sound bureaucratic but represent radical departures from central banking norms. The Term Auction Facility, the Primary Dealer Credit Facility, the Term Securities Lending Facility, the Commercial Paper Funding Facility, the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility. Each one was a trapdoor that allowed the Fed to inject liquidity into markets that were seizing up. But the big one, the facility that really tells the story, was the Term Auction Facility, or TAF. Launched in December 2007, before Lehman even collapsed, the TAF allowed banks to borrow directly from the Fed using a wide range of collateral, much of it toxic. Between 2007 and 2010, the Fed lent over $3.8 trillion through this facility alone. $3.8 trillion. And here's the kicker, the loans were made at below market interest rates. Banks that were insolvent, that should have been wiped out by their own recklessness, were given cheap money by the central bank to stay afloat. It wasn't a bailout, it was a subsidy for failure. Now, let's talk about the international dimension, because this is where it gets even more insane. The Federal Reserve didn't just bail out American banks, it bailed out the world. Through a mechanism called central bank liquidity swaps, the Fed extended dollar credit lines to foreign central banks, which then lent those dollars to their own domestic banks. The European Central Bank, the Bank of England, the Swiss National Bank, the Bank of Japan, they all received unlimited dollar swap lines from the Fed. Why? Because European banks were just as deep in toxic American mortgage securities as the U.S. banks were. Deutsche Bank, UBS, Royal Bank of Scotland, they were all leveraged to the hilt, funding themselves in the dollar repo market using subprime collateral. When that market froze, they faced the same liquidity crisis as Lehman. The Fed's swap lines were a backdoor bailout of European finance, paid for by the implicit debasement of the U.S. dollar. By December 2008, the Fed had extended over $583 billion in swap lines to foreign central banks. $583 billion. That's more than the official TARP bailout, and most Americans have no idea it happened. Let's zoom in on one specific example, Citigroup. In November 2008, Citigroup was on the verge of collapse. Its stock had fallen over 90% from its peak. Depositors were pulling money. Counterparties were refusing to trade. The U.S. government stepped in with a rescue package that included $25 billion in TARP funds, another $20 billion in direct capital injection. And here's the big one, government guarantee on over $300 billion of toxic assets. $300 billion. The government didn't buy those assets. It just promised to cover the losses if they went bad. In other words, taxpayers became the ultimate bagholders for Citigroup's bad bets. But even that wasn't the full story. According to the Gao audit, Citigroup received over $2.5 trillion in total support from the Federal Reserve's emergency lending programs. $2.5 trillion. That's more than the GDP of Canada for one bank. Why? Because Citigroup was deemed systemically important, too big to fail, too interconnected to allow to collapse. The government made a calculated decision. The social cost of letting Citigroup fail was greater than the moral hazard of bailing it out. But here's what they didn't calculate: the long-term cost of proving to every major financial institution that recklessness will be rewarded. The cost of teaching an entire generation of traders that risk has no downside. The cost of turning the central bank into a permanent backstop for asset prices. This is the parasitic nature of modern finance. The profits flow upward to executives and shareholders. The losses flow downward to taxpayers and currency holders. It's a one-way ratchet, and it's been tightened with every crisis since 2008. Let's talk about another player, Goldman Sachs. In September 2008, facing a liquidity crisis of its own, Goldman Sachs made a brilliant move. It converted from an investment bank to a bank holding company overnight. Why does that matter? Because bank holding companies have direct access to the Fed's discount window. They can borrow from the central bank in an emergency. Investment banks couldn't. That single regulatory change gave Goldman direct access to Fed liquidity. Within weeks, Goldman received $10 billion in TARP funds, plus over $600 billion in total Fed support through various emergency facilities. $600 billion. And remember, this is the same Goldman Sachs that had shorted the mortgage market, the same firm whose former CEO was now Treasury Secretary, overseeing the bailout. The revolving door between Wall Street and Washington isn't a metaphor. It's a blueprint, and Goldman Sachs is the architect. Now, let's talk about AIG in detail, because this is where the true scandal lies. AIG's collapse was driven by its financial products division, a unit based in London that had sold over $440 billion in credit default swaps. These were essentially insurance policies on mortgage-backed securities and collateralized debt obligations. As long as those securities performed, AIG collected premiums. But when they started default, AIG was obligated to pay out. The problem? AIG hadn't set aside nearly enough capital to cover the payouts. It was a naked bet, and short exposure without reserves. When the mortgage market collapsed, AIG owed tens of billions of dollars it didn't have. The Federal Reserve and Treasury stepped in with an $85 billion credit line in September 2008. But that wasn't enough. By November, the government had injected another $40 billion in TARP funds, then another $30 billion. By the time the bailout was complete, AIG had received over $182 billion in taxpayer support. $182 billion. But here's the part that should enrage you. That money didn't stay with AIG. It was a pass-through. The government money was used to pay out AIG's counterparties at 100 cents on the dollar. No haircuts, no negotiations. Full payout. Who were the counterparties? Goldman Sachs received $12.9 billion. Societe Generale, $11.9 billion. Deutsche Bank, $11.8 billion. Merrill Lynch, $6.8 billion. These banks had made bad bets, bought insurance from a company that couldn't pay, and when that company failed, the U.S. government made them whole. This is not capitalism. This is a cartel. And the name of the game is socialized losses, privatized gains. Let's bring this back to the repo market, because this is the engine that's still running today. In September 2019, more than a decade after the 2008 crisis, the overnight repo market suddenly spiked. Interest rates that are supposed to hover around 2% jumped to 10% in a single day. 10%. Banks were refusing to lend to each other overnight. It was a mini crisis, a warning sign that the plumbing of the financial system was still broken. The Fed's response? It started injecting liquidity into the repo market on a daily basis. What was supposed to be a temporary intervention became permanent. By March 2020, when COVID hit, the repo interventions exploded. The Fed was injecting over $1 trillion a day into the overnight lending market. $1 trillion every single day. This is the bailout that never ended. The emergency measures of 2008 didn't fix the system. They became the system. We now live in a financial structure that requires constant central bank intervention just to function. The moment the Fed steps back, the market seizes. We saw it in 2019. We saw it again in 2020. And we're going to see it again. Because the leverage hasn't gone away. The derivatives haven't been unwound. The shadow banking system is bigger than ever. As of 2025, the global derivatives market is estimated at over $1 quadrillion in notional value. 1 quadrillion. That's 1,000 trillion. A number so large it's almost meaningless. Until it's not. Every dollar of bailout money, every emergency liquidity injection, every quantitative easing program, they all have the same effect. They inflate asset prices. Stocks, bonds, real estate, they all go up. Not because the underlying economy is growing, but because there's more money chasing the same assets. It's monetary inflation masquerading as prosperity. And who benefits? The asset holders. The top 10% of Americans own 89% of all stocks. The top 1% own over 50%. When the Fed inflates asset prices, it's a direct wealth transfer from wage earners to capital owners. From the poor to the rich. From the young to the old. From the future to the present. This is the illusion. The stock market hits all-time highs, and the media celebrates. But for the majority of Americans, those gains are meaningless. They don't own stocks. They own debt. Student loans, credit cards, car payments, mortgages they can barely afford. And every time the Fed prints money to save the financial system, it makes that debt harder to escape. Here's the final piece of the puzzle. The $7 trillion figure. Where does it come from? It's not a single bailout. It's the cumulative total of the Fed's balance sheet expansion since 2008. From under $1 trillion pre-crisis to over $9 trillion at the peak of COVID. Now sitting at $7 trillion as of 2025. That $7 trillion represents assets the Fed has purchased. Treasury bonds, mortgage-backed securities, purchased with money that didn't exist until the Fed created it. That's not a rescue. That's monetary debasement. And you're living through the consequences right now. Inflation, asset bubbles, wealth inequality. All of it traces back to this decision to backstop the financial system with unlimited liquidity. The game is rigged, and the bailout is permanent. So where does that leave us? Here's the uncomfortable truth. We're not smarter than we were in 2008. We're just more accustomed to the insanity. The mechanisms that broke the world 17 years ago are still in place. In fact, they're bigger. The leverage is higher. The derivatives are more complex. The interconnections are deeper, and the central banks are more committed than ever to preventing any real reckoning. We live in an age of borrowed time, financed by borrowed money, backed by the implicit promise that the debt will never have to be repaid. Because the debt isn't the point. Control is the point. As long as the system stays liquid, as long as the markets stay calm, as long as asset prices keep rising, the illusion holds. But illusions don't last forever. They collapse the moment belief falters. And belief is fragile. Think about what happens the next time a major bank fails. What happens when a derivatives counterparty can't pay? What happens when the repo market freezes and the Fed can't inject liquidity fast enough? What happens when foreign central banks lose faith in the dollar and stop accepting it as the global reserve currency? The Fed has already used its biggest weapon, unlimited money printing. It worked in 2008 because people still believed in the dollar's value. It worked in 2020 because the crisis was seen as temporary. But what happens when the next crisis hits and the world realizes that the dollar is backed by nothing but the Fed's willingness to print more of them? That's the end game. And it's not decades away. It's on the horizon. Here's what you need to understand. The $7 trillion bailout wasn't a one-time event. It's an ongoing policy, a commitment to prevent any real correction, any real price discovery, any real consequence for the decisions made by financial elites. Every time the market wobbles, the Fed steps in. Every time a bank gets shaky, the government intervenes. Every time the system threatens to break, it gets patched with more debt, more liquidity, more monetary heroin. This is the moral hazard at the heart of our financial system, the institutionalization of too big to fail. And it's not just banks anymore. It's corporations. It's entire industries. It's the stock market itself. Anything deemed systemically important gets the bailout. And the definition of systemically important keeps expanding. In 2020, it wasn't just banks. It was airlines. It was cruise lines. It was retailers. The Paycheck Protection Program, ostensibly designed to help small businesses, ended up funneling billions to large corporations and well-connected firms. The rules were loose, the oversight was minimal, and the money flowed. This is the new normal: privatized gains, socialized losses, and a central bank that stands ready to print unlimited currency to keep the game going. But here is the question no one in power wants to answer. What happens to the currency when you do this forever? We're seeing the answer in real time. Inflation. Not the 2% target that central bankers talk about, but the real, lived inflation that people feel at the grocery store, at the gas pump, in their rent payments. Housing prices have doubled in many markets since 2008. College tuition has skyrocketed. Healthcare costs are out of control. And wages? They've barely moved. This is the hidden tax of monetary expansion. When the Fed creates trillions of dollars to bail out the financial system, those dollars don't just disappear. They enter the economy. They bid up prices. They devalue savings. They punish anyone who doesn't own assets. If you're young, if you're working class, if you don't own a home or a stock portfolio, you're getting crushed. And the system is designed to keep crushing you. Because the alternative, letting asset prices fall, letting bad debts default, letting the system reset, would hurt the people who own the assets. And those are the people with political power. This is the conspiracy hiding in plain sight. It's not a shadowy cabal in a smoke-filled room. It's a class interest, aligned across Wall Street, Washington, and the central bank. The interest of asset holders who will do anything, pay any cost, print any amount of money, to prevent their wealth from being marked to reality. And the cost? It's your future. It's your purchasing power. It's your ability to build wealth, buy a home, retire with dignity. All of it sacrificed on the altar of financial stability for the elite. So what do you do? First, understand the game. Recognize that the system is not designed to serve you. It's designed to serve the people who already have capital. Every policy decision, every bailout, every liquidity injection, it's a wealth transfer from your pocket to theirs. Second, protect yourself. Own hard assets, things that can't be printed. Real estate, if you can afford it. Commodities, even scarce digital assets, if you understand the risks. The point is to get out of pure currency exposure, because the dollar is being debased, slowly, quietly, but relentlessly. Third, spread the word. The reason this system persists is because most people don't understand it. They see the stock market rally and think the economy is strong. They hear about bailouts and assume it's necessary. They trust the experts because they don't have the time or the tools to dig deeper. But you do, and now you know. So here's my challenge to you: share this video. Not because I need the views, but because this information needs to reach people. The mainstream media won't cover this angle. The financial press won't connect these dots. It's up to independent voices, independent thinkers, people like you, to bypass the gatekeepers and get the truth out. Drop a comment below and tell me, do you think we're headed for another collapse? Or do you think the Fed can keep this going forever? I want to hear your perspective, your fears, your predictions. Because this isn't just my analysis, it's our collective reality. And if you're serious about understanding how money really works, how power really operates, subscribe to this channel right now. Hit the notification bell, because I am going to keep pulling back the curtain on the financial system until everyone sees what is really happening. The question we all have to answer is this: are we wiser now, or are we just walking the same path in better suits? The bailout is still happening. The money is still printing. The clock is still ticking. And the collapse? It's not coming. It's already here. We're just living in slow motion. Don't be the one who realizes it too late.